Hello, world. It's John Pinto, your disembodied voice as you're used to hearing me. Here with Jamie Myers of Travis Credit Union. Hi, Jamie.
Hi, John. Thank you for having me.
It's my pleasure. Don't you have some kind of disclosure you need to give me on your...
Yes, before we get into anything else, my NMLS license number is 312309.
Very good. I'm so glad that we did that. It sounds so official.
I know. Now, anybody watching, I'm not in trouble. Thank you.
That's right. That's right. As opposed to me, I've been in trouble ever since I was a little kid.
I bet.
You know, that's what happens when your mother has 4 boys and they're growing up in the streets of Brooklyn creating mischief. But that was another time, and here we are in 2024. Happy New Year, everybody. Yes, I've been a real estate broker for, it'll be 50 years in February 11th, 2024. And how long have you been a loan broker, Jamie?
I have been in the industry for 22 years. I have been licensed loan officer since 2006. So
long time.
That's a long time. 17 years.
Long time. So you're working now for Travis Credit Union?
Yes, I joined Travis Credit Union in November 2023. Prior to that, I was at Golden One Credit Union for about 3.5 years.
Oh, good. And tell us about Travis Credit Union and the niche product that you're most excited about right now.
Yeah, so Travis Credit Union has its headquarters in Vacaville. We get our name from Travis Air Force Base. That's where the Travis comes from. And we are actively our headquarters is there and surrounding areas, but we are very actively expanding into Santa Clara County and other Northern California areas. I would say the product I'm most excited when I joined there was our 100% financing program, which means zero down. Zero down, and it's not a VA loan. It's not any type of government loan. It's just our niche product. And you could purchase potentially up to about a $1,150,000 purchase price with zero down as a conforming loan.
Oh,
so
okay. That's pretty sizable.
It
so
is.
May I ask you a few questions about that loan?
Yes.
Okay. Is it good for condominiums?
Yes.
Is it good for townhouses?
Yes. Any 1-unit property.
And 1 unit, but no duplexes, triplexes, and fourplexes?
Yeah. Those require more down.
Okay. So we'll forget about those and just go with this. And what is the credit score required to qualify for that 100% financing?
Minimum credit score is 700.
Okay. And what is the debt ratio? And explain what a debt ratio is.
Yeah, so the debt to income ratio allowed on this product is 43%. And what that means is if you add up what your mortgage payment, property taxes, homeowners insurance, mortgage insurance, HOA dues, plus any other debts that you have like student loans or auto loans, and you divide that by your gross monthly income, it can't exceed 43%. So if your gross monthly income is $10,000, you add up everything, it can't exceed $4,300. That's how that works. And remember, we use gross income, not net. So
Right.
It's a big difference.
Okay, let's talk about that 700 credit score.
Yeah.
Let's say somebody does not have a 700 credit score, but they have a desire to own a home. Can you enlighten us on what it would take for them to get pre-approved by you, or at least pre-qualified, and then steps that you would take with them either on your own through Travis Credit Union or with a credit repair company to help them increase that credit score, and what kinds of activities would be involved in increasing that credit score?
Yes, absolutely. So I will say that there are other programs that don't necessarily require zero down, but could still have as little as 3.5% down that do allow for lower credit scores. But if somebody is looking to build up their credit score, the number one thing that somebody can do is look at if they have any credit cards that are maxed out or close to it, or even using, like 50 to 70% of the maximum credit limit on that credit card. And if you pay those down and keep that low, your credit score will definitely improve if that is what is bringing it down. So for example, let's say you have a credit card that has a $10,000 credit limit. If you use even over 3,000 of that, and definitely if you use up to 5,000, and if it's maxed out at 10,000, that reports to the credit agencies that you are using a high percentage of your credit limit, and it will negatively impact your score. The good thing is that credit scores are very fluid. So if you pay that down, the next month when the credit card companies report to the credit bureaus, that will improve your score. So that's something I think it's good to pay attention to all the time, but definitely if you're going to be purchasing a home, look at your credit cards and make sure to keep those balances low. It doesn't mean you can't use your credit card, just maybe make multiple payments a month, or, look into your savings if you do have a lot of credit card debt and just see if there's any way that you would be able to pay that off and still keep money for a down payment. That's important. You can't spend everything. But a lot of times people, they pay off their credit cards every month. They just maximize their limit every single month and then pay it off, and they don't realize that still negatively affects their credit score, even if it's paid off monthly.
Very good. And are you finding that buyers are gravitating towards certain more affordable counties?
Yes, we have seen a lot of that kind of stretching as much as their commute will allow or as much as their work from home will allow. So if they lived in the major Bay Area counties, they're often, moving to, let's say, Solano County, or if they're starting off in San Mateo, they may move to Alameda or Contra Costa County. And just as long as their employment works for it, I've definitely seen a lot of moves to less expensive counties. And of course, we've definitely seen people that can work remote leave California altogether.
And San Benito County is a very affordable county.
Yes, it is.
And you're, I won't say you're a stone's throw, but you are commutable to both Silicon Valley and the beaches in Santa Cruz and Monterey.
Absolutely. It's a great place to be, right in between paradise and your work.
That's right. Okay, well, that's a great opportunity for first-time home buyers. Now, let's veer off a little bit into low down payment programs where people might be able to buy a duplex, a triplex, or a fourplex. Yes. And the reason I mention this is right now we have a 15% affordability index. That is, only 15% of the families that live in any particular county in California can afford to buy the median priced home. That is a very tough number to deal with because property values have gone up since COVID-19. Interest rates have gone up since COVID-19 subsided. And also rents have gone up. So what do? Well, if rents have gone up and you're buying 2, 3, or 4 units, perhaps you can buy a duplex, a triplex, or a fourplex and leverage off those higher rents in the other 1, 2, or 3 units. Can you enlighten us on how that might work financing-wise?
Yes, and actually, Fannie Mae had a big change with this in November of 2023, so it's pretty new. So they will allow, you can purchase a 3 to 4 unit property as long as it is your owner occupied property, so you do plan to live in one of the units. And you can put as little as 5% down up to the standard conforming loan limit. So for a 3 unit property, that's just under 1.2 million purchase price. For a 4 unit property, it's about 1,475,000 loan amount. That's the maximum for 4 unit. For 3 unit, maximum loan amount is about 1,186,000. So you could go up to those loan amounts and only put 5% down on a purchase for a 3 to 4 unit property.
So 3.5 down FHA is for detached houses, condos, or townhouses, but the down payment flips up to 5% for duplexes, triplexes, and fourplexes, correct?
So I am talking about actually conventional, not FHA.
Oh, okay.
Yeah. FHA, while it allows 3 to 4 unit properties, it does have a guideline that makes it incredibly difficult to practically purchase a 3 to 4 unit property with FHA financing.
Okay, so basically then we would be going 95% conventional. And whether it's the 100% financing program or the 95% with 5% down, in general, what kind of concessions are allowed by the seller in terms of helping pay for the buyer's closing cost?
Yeah, so seller concessions, if you are putting at least 10% down you can get up to a 6% seller concession, which means 6% of the purchase price. So if you're buying $1 million property, you could get up to $60,000 for seller concessions. If you're putting less than 10% down, that's 3%. So on $1 million property, $30,000. Now, that is one way to look at the maximum. The other thing is that the credit from the seller can't actually exceed your closing costs. So most of the time, you don't have closing costs of $60,000. It's possible, but that's
highly unlikely.
Highly unlikely unless there's something else going on.
Yeah,
there.
Generally your closing costs are going to be 2, maybe 3% of the loan amount.
Yeah, depending on lots of things, they're probably somewhere between $10,000 and $20,000.
Okay. And that credit from the seller does not include things like asking a seller to pay the county transfer tax or the city transfer tax. That would be outside of the normal credit.
Right.
We're talking about the seller maybe paying some points so you get a little bit of a lower interest rate and also reduce your upfront cost. Is that accurate?
Yes. So there's the standard closing costs. Points can be paid to reduce your interest rate and payment long term. There's also something called a temporary buy down. And that if you do have a large seller credit, a temporary buy down can be used.
So a temporary buy down is maybe you buy it down 2 points in the first year, 1 point in the second year.
Right. So there's a few different iterations of it, but one of the most common ones is called a 2-1 buy down, which means let's just, as an example, let's say your actual interest rate is 6.5%. A 2-1 buy down means for the first year, your interest rate, the payment is based on an interest rate of 4.5%, and then the second year, your interest rate is 5.5%, and then for the remaining 28 years, it's at the actual note rate of 6.5%.
Okay.
Yeah.
Okay. Now, are you noticing some kind of a sweet spot in terms of first-time home buyer purchase prices and also loan amount and loan type these days? What are people partaking of?
Vast majority are doing adjustable rate mortgages. They've been a lot more popular recently, whereas I would say back in 2020, 2021, 30-year fixed was definitely the most popular because the interest rates were so low. I think there is a very widespread belief that interest rates will be coming down this year into next year, sometime over the next few years, that interest rates will be coming down. So adjustable rate mortgages typically have lower interest rates, and so the general strategy is to do an adjustable rate mortgage now, take the lower interest rate, and then refinance when interest rates come down.
I don't mean to get too cosmic on you, but from a numerology standpoint, 2024, the year 2024, heads up to 8. 8 usually bodes well. And I think in an election year, everybody wants everything to be lovely.
Right.
The Fed has indicated that for the moment, interest rate hikes are done, and they have indicated that rates may be flowing down this year. So when we're talking about ARMs, adjustable rate mortgages, we're talking about something other than a 30-year fixed rate loan, but we're not necessarily talking about an adjustable rate mortgage that's adjusting every month or every year, correct?
No, the most common ones are a 7-year ARM or a 10-year ARM. So those are still 30-year loans. The interest rates are fixed for 7 or 10 years, and then it begins to adjust. So 7-year ARM, you know what your rate and payment will be for 7 years, and then it begins to adjust. So there is some risk associated with getting an adjustable rate mortgage. So it's really important to understand that there is more risk. You do not know what your payment will be if you still have this loan after the 7 or 10 years and it begins to adjust. But you can save, a considerable amount of money by having an adjustable rate mortgage right now.
So let's talk about what that delta is.
Yes.
So we're going to talk about conforming loans, which I guess these days are a shade above $1,100,000. Is that correct?
Yes.
Okay. So what would the delta be between a 30-year fixed rate loan, a 30-year loan fixed for 7 years, and a 30-year loan fixed for 10 years? What's the difference in the annual interest rate?
So on a true conforming loan where the loan is going to get sold to Fannie Mae, or Freddie Mac, that is kind of the definition of a conforming loan, they typically have higher interest rates on adjustable rate mortgages than 30-year fixed. It doesn't make logical sense, but that's just how they price. So most of the time on conforming loans, I would say people are still doing 30-year fixed because it just makes sense. The rates tend to be lower than adjustable rate mortgages. However, if you are doing a jumbo loan, which either means the loan amount is higher or you're doing a conforming loan amount but still eligible for a jumbo loan program, which typically means you have more reserves, slightly lower debt to income ratios. The difference between a 30-year fixed and an adjustable rate mortgage on a jumbo loan, I would say about 0.5%.
0.5%.
Yes.
Now, is that for the 30-year fixed for 7 or the 30-year fixed for 10?
I would say between the 7-year arm and the 30-year fixed. And a lot of times the 10-year arm will be somewhere in between there.
Okay, so about 0.5%. So 0.5% on $1 million loan or a $2 million loan amounts to some real money, right?
Yeah, it could be several hundreds of dollars per month.
Yeah. Very good. And in terms of purchase price, what purchase price are you noticing first-time home buyers are gravitating to these days?
It really depends on
the county.
On the county. So most of my business is in Santa Clara County. So I would say that has tended to be in the 1.2-ish up to 1.5-ish in terms of the first-time home buyers there. But there are, I would say probably the lowest I've seen is in the 700,000 to 800,000 for first-time home buyers in that county. And I know it's very different. My headquarters for Travis Credit Union is in Vacaville, and that's very much more in the probably 500,000 or so purchase price.
Right.
Yeah.
Very good. Okay. Well, is there any other parting remarks you'd like to make before we conclude this video?
No, I think 2024 and 2025 are going to be great years. I see interest rates are going to be coming down. Hopefully, that's what all indicators seem to lead to. So I look forward to helping everybody buy a home.
Very good. And with these loans, you have to ask yourself, how long is it? Not only that I'm going to own the house, but I'm going to keep the loan.
Right.
A lot of people wind up refinancing at the drop of a hat. And there is risk in the rate going up at the end of 7 years. But if you take a 0.5% loan per year times 7 years, that's money in your pocket.
Yes.
That's not speculative.
Yes.
So I think the adjustable rate mortgages have a place for sure.
I do. I think they have a place. I just think it's important for people to understand that risk and be okay with it.
Yeah. So if someone wants to contact you by mobile phone, text, or email, how do they contact you, Jamie?
Yeah, my phone number is 510-630-5776. And my email address, it's jmyers@traviscu.org.
Very good. Well, Jamie, thank you so much for imparting your information about Travis Credit Union and first-time home buyers, and especially that 100% financing. That is a very big deal. I'm definitely going to put that in my tool belt and use it.
Great. Thank you very much, John.
Very good. And thank you all for tuning in to Jamie on screen and my disembodied voice. And we will see you again on the next video. Bye for now.